special Diwali show we are calling the Funda of Funds. I'm Tanveer Gill in the Mumbai News Center with my colleague Nikunj Dalmia.
So Tanveer, first of all, happy Diwali to you.
Happy Diwali to you.
You're looking amazingly pretty in this red sari.
Thank you. Okay. But it's all about the outperformance that mutual funds have shown this year.
Yeah, I mean, this year was supposed to be a dull year. It has turned out to be a dream year. Whatever could go wrong has technically gone wrong, from Trump tantrums to impact of demonetization, impact of GST. But what a year it has been. You know, the classic market saying, I think, has turned out true, which is that bull markets, they indeed climb the wall of worry. Yeah. But if bull markets, they climb the wall of worry, they always come down when there is a lot of ray of hope. And is it hope or liquidity? What really could be the driving factor going forward? So to really understand what lies ahead and what could be the way forward for this Samvat, let's connect with three of the smartest fund managers on D Street. Mahesh Patil of Birla Sun Life, Manish Gunwani in his new role. Now he's with Reliance AMC. So Manish, congratulations for a new role.
Thank
Welcome
you.
to the show. And the evergreen Navneet Manot, still endorsing the green color. Will that be the color of this Samvat as well?
Looks like, I mean, it's been an interesting year last year. Markets delivered compared to last Diwali around 20%. On one side, I mean, the domestic liquidity flows have continued, while the reforms, whether it's the demonetization, GST, real estate regulatory authority, direct benefit transfer, monetary policy committee framework, I can just go on. All of these, so markets are hoping that over a longer period, they will help in putting a structural foundation for a sustained growth with low inflation. And on the other side, liquidity flows have, of course, helped. What we need to see next year going forward is the earnings growth, and that's imperative given the valuations where they are.
I think we forgot the disclosure that if you ask a fund manager for a market outlook, it will always be bullish. With that disclosure, let's start the show.
Not necessarily.
A mutual fund manager. I don't know about hedge fund managers, but mutual fund managers, they're always on the positive side.
No, not always. I think whenever there has been any risk, whether in terms of global economy, domestic economy, markets, we've always highlighted that.
Okay, but Manish, you know, looking into the future, from this Samvat to the next, do you believe the market can continue its move up? I mean, we're at record highs. It's so auspicious that around Diwali we've hit record highs. But
Right.
can that momentum sustain?
I think so, because I'm quite positive on the earnings side of it. I think while liquidity obviously has a big role probably to play in the last year, I think what's also important to see is that after many years, after probably 6-7 years, you're getting global growth back.
Yeah.
So after many years, you're seeing all the major regions do pretty well, whether it's US, China, Japan, Europe. And I think that has a big role to play in terms of the chances of Indian economy also coming back quickly. So given the fact that we've got two arrows like demon and GST, which are behind us now largely, and the fact that global growth has come back, I'm pretty positive that growth will come back and we'll have a great earnings year.
Okay. Would that mean, Mahesh, I'm putting you on the spot, would that mean next year, Diwali time, we would be above 11,000? Or do you think that, you know, given the run-up that we've seen so far, there is a high chance that we would perhaps be adjusting lower below 9,000 or around that mark?
I would agree with what Navneet and Manish has said. Up till now, we have seen the market go up, okay, without any underlying improvement in the fundamentals. But I think a lot of the things which have happened in the last 1 year, I think our belief is that that should lead to a more structural improvement, okay, in the economy, and that should get reflected in the stocks and the company's earnings. And many sectors which were probably doing bad last year, whether it was the metals earlier, the banking and financial, pharma sector, I think they have kind of bottomed out. So the negative pull down which was there because of these sectors on the earnings should kind of normalize.
Now for this Samvat, is it important to hunker down return expectations? You know, courtesy good performance by mutual fund managers, we've had good double-digit returns. In small caps, the returns have been grand. But should we now, or when I say should we now, should investors and unit holders now prepare for a single-digit return? Is that scenario at play now?
May not be a single digit, but of course in low teens. Simply that you have to see in a context
and
that
this is large cap and small cap both, right?
If India is going to have a CPI inflation of 4%, if rates are likely to be at 5-6%, then there is a logic for a lower equity risk premium or cost of equity. And from that perspective, I think even if you make 12% or so from equity market, that should be considered as a decent return. So return expectations going forward, looking at the valuations where they are, should be moderated.
Manish, exactly the same question. Is it time to hunker down expectations?
So the way I would look at it is look at a block of 3 years. I think cumulatively we could probably get 50 to 60% earnings growth. I also feel that you can't expect PE rating. Maybe you might lose 10% on PE also, but net you're going to make double-digit returns on 3-year basis, is my view.
Manish, in cricket terminology, last 2-3 years have been flat wickets for us. Tic-tac-toe and you've made money. But do you think now is the real test where you may be thrown an odd bouncer, maybe a global googly? So one needs to be extra careful, not only to generate returns, but also to protect capital. Are we reaching there yet? Or you think that for next 12-18 months, there is no problem whatsoever and the bull market will continue to, build itself up?
Very difficult to call, but my guess is globally the situation will remain benign for some more time. Purely if you go by history, I mean, emerging market rallies typically last 40 to 50 months. And it looks like Feb 16 was the start of the emerging market bull run this time. Now, in a way you look at dollar, I mean, peaked out around 103, about 92, 93, the dollar index. Typically, again, in an emerging market bull run, it tends to lose about 25-30%. So if I just go by economic history, that is point number one, that probably has some way to go. Two is, again, not even India. If you look at places like China, Brazil, Russia, the capex there for the 2011 to 16 period was, had fallen so dramatically that when it comes back, I do think that lasts for 3-4 years. I mean, India, we still haven't even seen some kind of cyclical recovery yet. So once it starts, it's like an elephant turning around. It just takes time to turn around, but when it starts moving, it goes on for some time. So my sense is, in terms of both global growth and global liquidity.
As a fund manager who looks at the entire gamut of asset classes, how would you advise investors to balance out between the two divides?
So first of all, on global monetary tightening, I think there's a normalization of the monetary policy. We ran an extraordinarily accommodative policies since the global financial crisis. Now that global economy is moving up or growing in a synchronized fashion, right from, as Manish mentioned, I mean, right from US to Europe to China, Japan, emerging markets, I think the global economy is doing pretty well, and it's time that central bank starts unwinding the excessively loose monetary policy, and it's likely to happen over the next few years. But that's good for the global economy. From an India's perspective, where we invest all our money, I think fixed income, looking at the recent data points and some bit of pressure on the fiscal side, expecting substantially lower interest rates from these levels would be tough. Having said that, I think if we are structurally moving towards a scenario of 4% CPI inflation and a government which is highly committed towards fiscal consolidation, then I think rates are likely to remain at a lower level for an extended period. So it's a good scenario for a fixed income investors, but you cannot expect very high capital gains. Equities from a 3 to 5 year perspective still look better. Another asset class that looks attractive is commercial real estate. I think with the impact of the RERA, I think incremental supply for some time is going to be low. And I think in an inflationary economy, if you get like 7-8% rental yields, it's quite decent. That's a real yield investor need to consider. But Naveen,
if I had $100, and this is again an extension to what Nikunj asked, I want to aim towards some bit of capital appreciation, but also protect my capital. So how should I divide? And I'm asking this on.
So then in the mutual fund space, we have funds like Balance Fund, which are investing 65 to 75 in equity and remaining in fixed income. You can look at the other conservative balance funds where the equity portion may be around 30 to 50% and remaining in fixed income. So you have some of these kind of hybrid products which investors can look at for a overall asset allocation perspective.
Okay. Now, before we move to round 2 and talk about theme sectors and what your top ideas could be for this Samvat, I just want to clear the air, because on a daily basis, Tanveer, I guess we've been addressing that, are we in a bubble zone yet? Looking at the euphoria in the IPO market, it's often said that retail investors wo peak par aate hain. And looking at how the flows have been. So I just want to clear the air on this much. And a very quick 25-second answers from each of you. Are we in a bubble territory?
Definitely no, I would say. I think bubbles are created, okay, when there is high valuation and also when the cycle, economic cycle at its peak. So currently we've got high valuations, but the economy at its bottom, right? And there is a lot of skepticism. You only said this is a rally of skepticism. When there is a bubble, everything is positive. We haven't seen really some of the low quality stocks really scaling their earlier highs. I mean, that's what typically happens in a market bubble. So we are not really in a bubble. I mean, it looks apparent because the P multiples are higher, but I think that will normalize. So definitely not in a, yeah, I mean, we are somewhere in the mid of the cycle, I would say.
Okay, Manish, I'll take a leaf from Mahesh's answer. What causes the market top? Valuation froth and participation froth. Valuation froth not there, but participation froth?
No, but
look at what is happening to IPOs. These are crazy numbers, unheard of subscription numbers are coming through. So I'm just getting your thoughts here.
So my view is this, that even in a large bull run, you will get temporary corrections based on oversupply, some pause in earnings, whatever. So if you looked at 2003 to 8, in 2006 May, the market corrected 20 odd %, the mid-cap index corrected almost 30% in 1 month. So you have to be ready to live with those kind of corrections. But if you ask me, I do think that we are part of a fairly long bull run which started in 2016 Feb.
And Amit, you know, if you are to follow the inflows from into mutual funds from domestic investors, that's telling that this liquidity flow is likely to continue. That kind of faith from the domestic investors is likely to continue.
I mean, a good part of it is structural in nature. If you look at the numbers in terms of the SIP flows that industry is getting, you also add the money that's coming from the pension funds, that's structural in nature. Maybe, I think, depending on the market mood or market swing, there could be some bit of swing in the flows also. But a large part of these flows look like structural in nature.
But you know, money is not made in markets by betting on yesterday's growth. You have to identify tomorrow's trend. I mean, markets are a forward-looking mechanism. That's what markets are made up of. So what could be a money-making proposition for next 2 or 3 years where you think either there could be a P expansion or there could be an earning expansion? And before you answer this question, I'm not giving any 3 of you to use the word private banks. So you're not allowed to use private banks. Anything. NBFCs will get different views, I'm sure. Okay. Apart from private banks.
So in that case, I think, I mean, as we get closer to the resolution of the NPA cycle, then maybe some of the corporate lenders could be, I mean, near bottom, you don't know, I mean, another quarter or 2. Some of the other contrarian ideas could be, I think, the consolidation in the telecom sector. Could also be, I think, as the investment cycle revives, the government spending is happening, but at some point in time, in next couple of quarters, private capex is likely to revive. Then maybe parts of the industrials in capital goods, engineering, construction. Some of these are like contrarian ideas, since you asked for the things that have not worked in last few years but may work. But otherwise, if you clearly look last few years, what has really worked is the earnings momentum. And
that automatically led to
the private banks and some of the discretionary, consumer discretionary in the autos and all. So you can clearly divide the market into 2 sections. Wherever earnings momentum has been strong, price momentum has been
the only
strong.
Place where you could be contrarian among corporate lenders is ICICI Bank and Axis Bank. So I know you're not taking it, SBI also, yes, that one too. But you know, in private lenders, I think those are the only 2 which have underperformed.
No, even at some point in time, if you look at the IT, it's interesting that if you look at this global synchronized growth as well as the asset market rally, the main driver of this rally has been technology companies, right? In US, China, Korea, Taiwan, you look at every market. And unfortunately, in this cycle, Indian software services guys have not been able to participate simply because they didn't invest in those kind of businesses where we should have invested. But purely from a valuation perspective, at some point in time in next 1 year, I mean, the kind of free cash flow yield that they have, at some point in time, they will look attractive purely as a value, may not be as a high growth.
No, fair point. Manish, what could be your, big idea? Your new mandate is to...
A lot of my list has been taken away.
But your portfolios are different.
Manish spoke about telecom seeing a turnaround in earnings.
No, I said earnings at bottom. Similar to, I think pharma is a decent space to be because a lot of the headwinds are, I think, more or less behind us. I think apart from that, a couple of small niches. One is some plays on rural recovery we are quite positive on. The second is there's some mid caps which have exposure to global capex spending. I think those niches are quite interesting for us.
Mahesh? No private banks. That's the disclosure.
I think
Apart from
if you
private
want
banks.
to take a contrarian view, I would agree that pharma sector could be looked at. I think a lot of good companies which are there, which are investing, continue to invest into R&D, going through a kind of a bad phase because of a lot of issues, structural issues. But we think that good companies, okay, who are investing, continue to invest into specialty products. I think you could see a turnaround over there. So that's one of the contrarian. But apart from that, I think while it might sound cliched, but I think the consumer discretionary story in India is again a very long-term story and it will continue to grow with lower interest rates. Okay, that will only fuel further growth, lower penetration in these categories. GST, I think the benefit of GST is still not, we are seeing the pain of that, but the benefit of that will flow through some of these companies through logistics gains, reduction in inventory cycles, and obviously a gain in market share from the unorganized sector. So I think that looks to be a very long-term structural story where companies with good brands, good products, pricing power will continue to grow and expand and gain market share.
Right. The consumption theme in autos has largely played out on the two-wheeler side with, Eicher Motors, particularly with Eicher Motors, perhaps not so much with Bajaj Auto, Hero MotoCorp, and on the passenger vehicle side with Maruti. But do you believe that it's time that, the low-premium two-wheeler names, the tractor companies, as well as the CV makers now have the potential to catch up, Navneet, in the coming year?
I think as the growth becomes more widespread, both locally as well as globally, some of the names that you took could be interesting.
Mahesh, you said consumer discretionary. Now, the easy way to buy consumer discretionary is buy autos. Now, auto again is a very divided picture.
So autos, again, it's a fairly penetrated market, really. You have to go down because you're looking at now some of the where the per capita income is low, which is increasing. That's the story which you're trying to play out, right? Where the growth could be higher. Auto companies are doing well, generating good free cash flows. They'll continue to do well, but the real bigger growth, and that sector is fairly organized, right? So if you really want to play from unorganized to organized, then you have to look at some of the other smaller ticket consumer discretionary space where the return and the growth over the next 5 years or next decade could be much higher.
Okay, so Manish, now you've heard ideas from Navneet, you've heard ideas from Mahesh. How are you planning to beat their performances? What will you do so different this year?
Copy them probably.
Have a little chat on the phone. What did you buy? Interesting. No, but insurance, Manish, let's talk about that. There's so much paper that's come into the markets. I was just discussing with Nikunj about how, while we are still wrapping our heads around the general insurance business, the life insurance business, now you have this reinsurance business which is coming in, which, where the scope and scale is not largely understood because it's, catastrophe insurance, it's disaster management, but it's still an opportunity in the market. How do you size the insurance sector?
So one of the segments we've been very bullish on has been general insurance, because I think in terms of penetration, that is one of the most underpenetrated segments, not only within financials, but if you compare with consumer products or any other segment, the level of underpenetration in health, motor insurance is quite high. Life insurance, I think a lot of the value, frankly, I think has been discovered. And then we have the AMC coming up. So I think there are various segments which are very interesting within the financial space apart from banking itself.
Will you buy AMC stock?
So overall, that
financial inclusion is a strong theme.
Yeah, the financialization of savings, digitalization of finance, I think clearly some of these are good beneficiaries, but I always give the example of telecom. 10 years back, there were like 100 million subscribers and they have moved to 1 billion subscribers, but telecom companies didn't make money in 10 years. I think we have to look at individual companies and the competitive advantage that they can create.
You've always spoken about, the big themes that you're going to look at buying or, accumulating more or allocating more to in the coming year. What about booking profits? Where do you think valuations are stretched, where you would want to take some money off and give returns to investors or show a higher return on the funds?
No, I think again, it will come down actually to individual companies, right? So be it say some in the NBFC sector or some of the consumer names, okay, if they are really reached high and the growth is tapering. I don't see that it can be a call across as a sector, you can see, because within that there will be a lot of disparity in terms of growth and what the longer term opportunity would be. So I think it comes down more stock specific rather than any particular sector.
Even in NBFCs, because everything in NBFCs
Not
is...
really. Second, NBFCs again, yeah, I mean, arguably their multiples have gone up quite a bit. There has been a huge re-rating which is there.
That baffles Nikunj every day.
Yeah. So I think it's more
I'll tell you what baffles me. There's just one company, which is Avenue Supermart.
Yeah.
Sure. That's something.
Who's going to answer this one? Why is Avenue Supermart commanding a market cap of 70,000 crore for a business which has margins of 4%?
And I can't answer a stock
Retail,
specific,
retail.
But
All
it's
retail
again,
stocks have done that.
same, that, valuations are looking stressed, something that Mahesh was alluding to.
So, I mean, just not again answering that, not Avenue Supermarket. I think it's a question about what is the return, forget about margins. What is the return, ROCs or free cash flow, and what is the visibility of growth you are looking at? I think that is the bigger picture. Normally, when you look at a company, look at for next 2 years, 3 years time frame. I mean, if you have a really mirror and you can look beyond that, say next 5 years, 10 years, and what the growth opportunity could be, then you can discount that much better and then peg a value to it. So I think where there is a big opportunity there, untapped opportunity and growth, and you can see that visibility, I think the valuations can be high. One can debate whether what is the right valuation, but I think that's where looking further down, looking at that visibility and sustainability of the growth is really key to identifying some of these stocks and valuing some of these high growth companies.
Okay. Manish, let's start getting closing comments, and I do not extend our Diwali appointment with you. Where do you think there is potential of a double-digit stock return based on the current entry points for next 3 years? Where do you think stock prices could give you a 10 to 15% kind of an CAGR return for next 3 years? It could be a group, theme, sector, whatever you want to choose. And Navneet, I'll ask you the same question so you can start thinking.
So it's that list again: corporate lenders, pharma, some early cycle capital good plays, logistics. I think those are the segments which should do well next 3 years.
Yeah, same one I mentioned earlier, and there is no new other name that's coming to mind. But I mean, India, as the growth becomes more widespread, also if we can take advantage of the synchronized global growth. I mean, we were just discussing about the chemicals name earlier. There could be a variety of different sectors who can benefit from the synchronized global growth, other than the growth revival in India, particularly on the investment side.
Mahesh, what is unlikely to give a double-digit growth now in stock performance? You always focus on what fund managers buy, yeah?
Again, that's again a difficult this thing to say, but I think you could be probably some of the consumer names. They'll be steady. They can give you closer to around 10-11%. But yeah, if you're looking at high returns, the consumer staples I'm seeing will probably not give you very high returns, but they can give you moderate returns. Obviously, there are risks in some of these sectors. Like for example, capex cycle. It's again a hope, right? So there could be risk in that from a near-term perspective, because we've still not seen that private sector capex really emerging. But yeah, over a 3-year period, I think there are a lot of sectors. Most of the companies should give at least double digit, right? 10 plus. I mean, that's if you're expecting market.
Yeah, matching nominal GDP.
Yeah.
Okay,
so Tanvir, we can magnify and we can talk about sector themes, ideas, where valuations are stretched, where valuations are not stretched. Ultimately, I guess the messaging this Diwali has to be that how many Indians have got their asset allocation right. And 80% of the gain is made if you don't get your asset allocation right. So I think the messaging this year has to be that you should rise with India, and to rise with India, you have to invest wisely and get your allocation right. All the conversation centered around where and how is secondary. Get your asset allocation right. That should be the messaging, right?
Yeah.
Let's hear a loud yes.
Yes.
Okay, on that note, thank you very much. You've heard it from the 3 wise men of the mutual fund industry who've done their bit this year to give you returns, and will continue to work hard to do just the same in the next Samvat as well. I thank all 3 of you for taking out the time and being a part of our Diwali programming. Happy Diwali to you.
Happy Diwali.
Well, with that, we come to the end of this edition of the special Diwali show, Funda of Funds. Hope you enjoyed it. Thanks very much for watching the show from Nikunj and myself.